For a few weeks in early 2018, the same Bitcoin cost far more in South Korea than it did in the United States. Not a few dollars. Thousands. Anyone with a phone could see it. Two screens, two prices. One obvious question: why not just buy it cheap here and sell it expensive there? It was the most obvious trade in crypto. It was also almost impossible. The handful of people who actually pulled it off used the money to build one of the biggest crypto exchanges on earth. It was called FTX. And the exact instinct that made them rich is the instinct that later blew it all up. Traders had a name for it: the kimchi premium. The price of Bitcoin on Korean exchanges, floating stubbornly above the rest of the world. Most of the time it was small, a few percent, but in the mania of late 2017 and early 2018, as Korea went crypto crazy, it exploded to over 50%, peaking around 54% in January 2018. Other world of Asian markets had smaller premiums of their own, but Korea's was the giant. Now, markets aren't supposed to work like this. If something is cheaper in one place, buyers rush in, sellers rush out, and the price snaps back into line. That's the whole idea of an efficient market. So, why didn't it snap back? 3 reasons. 1. Capital controls. Korea makes it genuinely hard to move large sums of money in and out of the country. 2. Retail frenzy. Ordinary Koreans piling in faster than anyone could supply coins. And 3. The market was effectively walled off. The normal pipes that would let arbitrageurs flatten the gap were clogged. The gap wasn't a glitch. It was a gap the market physically could not close, which meant it just sat there screaming free money at everyone who looked. The catch: looking at it and taking it are two very different things. On paper, the trade is 5 steps. 1. Buy Bitcoin on a US exchange at the cheap global price. 2. Send that Bitcoin to a Korean exchange. 3. Sell it there for 1 at the higher price. Pocket the premium. 4. Convert the won back into dollars. 5. Get those dollars home. Then do it again and again, simple, until you actually try it. Because between sell high in Korea and dollars back in your US bank account stands a wall. Capital controls and withdrawal limits. Korea caps how much money you can move out. You can't just wire out millions in won. Banks move that kind of volume, and compliance departments freeze your accounts, demand paperwork, or shut you down entirely. Time is risk. While your Bitcoin is in transit minutes to hours, the premium can shrink or vanish. You can lock in a loss mid-trade. Repatriation. This is the real killer. Selling for won is easy. Turning a mountain of won back into US dollars, legally, at scale, without tripping every alarm, that is the hard part. So the premium was real, but for almost everyone, it was unarbitrageable. Not a buy low, sell high click. An operational war, banking relationships, money movement logistics, legal gray zones, and nerves. Win that war, and the premium was a money printer. Lose any single piece of it, and you were stuck, holding one you couldn't get home. Most people lost, a few didn't. Sam Bankman-Fried didn't come from crypto. He came from Jane Street, one of the most secretive, sophisticated trading firms in the world, where the entire job is arbitrage. Finding tiny price differences and squeezing them at massive scale. To that mindset, the kimchi premium wasn't a curiosity. It was the biggest, dumbest, most obvious arbitrage any of them had ever seen. In September 2017, he co-founded a trading firm called Alameda Research. The early crew was small, coders and traders like Gary Wang, Caroline Ellison, Nishat Singh. What they did that others couldn't wasn't clever math. Everyone could do the math. What they did was industrialize the plumbing, the bank accounts, the money movement, the logistics, pushing volume through the wall where everyone else got stuck. How much did they make? Here's where the legend and record split. The story that gets repeated is around $25 million a day, but that number was never confirmed, not in Michael Lewis's book, not in the testimony at Sam Bankman-Fried's trial. The most concrete figure comes from Bankman-Fried himself, who once said Alameda was making, quote, $1 million a day in some cases. 1 million, not 25. And even that is his word, not an audit. Treat the daily legend as folklore. What's clearer is that it was not smooth. By some accounts, a transfer went wrong, and a large sum, reportedly around $4 million, briefly vanished, and the early team fractured over how reckless the whole operation had become. The pattern is already visible. Enormous upside, captured at speed, with the guardrails as an afterthought. The arbitrage cooled. Premiums always do, once enough capital floods in. But now they had two things: a war chest and a taste for turning market gaps into money. So in 2019, they built their own exchange, FTX. They launched a token, FTT. They sold a stake in the company to the biggest exchange in the world, Binance, a deal that would come back to haunt them. And they marketed hard. Stadium naming rights, Super Bowl ads, celebrities. In a few short years, FTX was valued at around $32 billion. But one thing never changed from the arbitrage days. Alameda, the trading firm, and FTX, the exchange holding customers' money, were entangled from birth. Same people, same origin, same blurred line between our money and everyone's money. Remember the instinct that won the arbitrage? See a gap, move fast, don't let boring rules slow you down. Treat money as one big fungible pool to be pushed wherever the opportunity is. That instinct built the fortune, and that same instinct, money moved between Alameda and FTX as if the customers' billions were just more capacity in the machine, is what detonated it. When it unwound in 2022, it wasn't a sudden change of character. It was the original character, finally without a wall to stop it. The arbitrage was never the crime. The arbitrage was brilliant. The crime was what happened when the same operators had no one and nothing telling them where the line was. Arbitrage is just the market fixing a price gap. The gap is real. Taking it is brutal. And the distance between genius and criminal isn't the trade, it's the guardrails. Next time, your stablecoins aren't as much yours as you think. How Tether can freeze USDT. And the cases where it did.